Hey, this is Jim Musgrave, and welcome to my Q1 2026 State of the Markets video. Again, we do this every year, and I just wanted to take a few minutes to kind of give you a better idea of what we saw last year, what we see moving forward, and a little bit about Musgrave Financial Solutions. So I send this out to my clients, but I just also send this out to people who are considering working with us just to give you a better idea of how we kind of work as a financial planning firm. So in terms of our agenda that I'm going to go over here, if you are a client, we are going to actually talk about and give you a financial organizer. So this is going to be new for this year. And the financial organizer is a 3-ring binder about 3 or 4 inches thick that fits all of your personal financial information. I've been using mine for many years. And so you can schedule a time to come by the office or do a review, and we can get your organizer for you. But it's where you put all your important documents. I keep mine in a safe in the basement, which is very good. The second thing we're going to talk about is sort of our mission and also scaling the business. We got some exciting things going on with our firm. We're also going to kind of recap 2025. And then we're going to kind of shift to some of the policies that have kind of been implemented in the last 12 months or so that have really impacted the economy and also us as investors. And we're going to share with you some of the strategies to best position your portfolio. And in another video, we'll do a Q&A with Diane Kuwamura. She's an estate attorney that I work with a bit, and we tend to do a lot of kind of Q&A. So that'll be a second little piece on this kind of update here. Okay. So I want to kind of share with you the mission statement of Musgrave Financial Solutions, just to be very, very clear of who we are and what we're doing. And it's just very, very simple. Again, our mission is to provide tailored retirement planning services consistent with the fiduciary and best interest standards, which help our clients to clearly understand their options, make well-informed decisions, provide financial security, and preserve their legacy. So this is what Musgrave Financial Solutions, this is our mission, this is what we do, this is how we help our clients. So I thought that was a pretty clear statement of what we're trying to do, or what we do consistently as a planning firm. Okay, so how do we do that? One is that we do a lot of educational workshops. In 2025, we did a series of over 7, and mostly Montgomery County and Northern Virginia. We do a lot of updates as well. We also do our planning process. So most people kind of learn about us through our educational workshops. We give everybody access to our planning software, which is called Money Guide Pro. And we take a snapshot of your finances. And before you make any decisions whatsoever, we want to model out different scenarios. And so by taking a snapshot, if you do nothing, this is where you're going to end up. But what if we change this scenario? What if we file for Social Security at a different time? What if we delayed that pension? What if we became a little more aggressive or more conservative in the portfolio? What if we use this particular insurance product to address a certain risk? Okay, so we try to model that stuff out so you can be very well informed and understand where that's going before making that decision. And again, that's sort of what we're doing right there. What I just kind of mentioned is that we, again, compare our current scenario with different scenarios, which helps you to make well-informed decisions. Okay, so the planning itself determines how your portfolio looks. And we have a very wide range of institutional money managers, custom portfolios, separately managed accounts, and dozens of different insurance products that we get through a variety of different insurance brokers. But it's really the process that's more important. And then once we figure out the direction, then we kind of go and figure out the best tools in the toolbox to implement your strategy. And then we work with a fairly high net worth group of people. And as the client's net worth increases, once we get north of 4 or 5 million, tax planning and estate planning become increasingly more important. So it's very important to kind of coordinate with our clients, CPAs, attorneys. We have relationships that we can introduce you to people, but if you're working with somebody, it's really important that we're on the same page and share ideas to make sure that we're kind of working holistically for you, our clients. And finally, we also do client reviews, at least on an annual basis, to make sure that you're on track. If there's any changes that need to be made, we actually can make those changes very, very quickly. So that's our process on how we kind of live up to and implement our mission statement. Okay, so the other thing is, I'll just let you know, is I was in Scottsdale, Arizona a couple weeks ago, and a group of roughly 300 business owners from all over the country. We were all there for a 3-day conference to learn how to scale our business. And my mindset just really, my vision just expanded exponentially. So one thing that's really important to me is you, my client, is that if something happens to me or anybody else, that we have a seamless transition in terms of continue to working with us with our planning. We already have a succession plan in place. I just think we can improve it. So the things that I'm going to be focusing on this year is on 4 different areas. We're really going to be focusing on building the infrastructure of the business so we can continue to scale. So we're going to be focusing on people development. We're going to be hiring. My goal is to have another 2 or 3 advisors under the firm by the end of the year, but we're also going to have to hire some more support staff to handle that as well. We're also going to be focusing on expansion and operations planning. We're going to be focusing on financial modeling and reporting. We've got to make sure that all the numbers are making sense. And we also are going to be focusing on sales and marketing execution. Okay, so those are the 4 areas that we're really going to be focusing on, because as we expand as a firm, we don't want to be crushed by our own weight and our own success. So I'll be spending quite a bit of time in 2026 kind of really continuing to build that infrastructure out. Okay, as I said, my goal is to have at least 2 new advisors under our umbrella by the end of the year. Okay, so let's kind of talk about the market recap. I have this picture here because this is a picture from a resort I'm actually going to go to shortly called the Body Holiday down in St. Lucia. So I took pictures of the sunset every night, and this was one of the sunsets. So I thought that might be an appropriate picture for this time of year, especially given all the snow and cold weather we've been having lately. Okay, so at the end of the day, we are in an expansion. The market continues to grow. We're actually pretty bullish on what's going on in the market as a whole. And so we've actually really been in a pretty bullish posture started in 2023. So the last 3 years or so have been pretty good. And this is the U.S. Recession Dashboard by Franklin Templeton. And you can see in this slide that, obviously there's been years in the past and periods of the past that were bear market recession. You can see 2007 to 2009. You see all those red X's. Okay, so we are nowhere near that situation like we were in those periods of time when we are in a bear market recession. So overall, we are very optimistic and bullish, and we'll kind of go a little bit more into that. But again, you can go to my website, mfsadvisors.com, scroll down to the bottom of the homepage, and see these reports right here. Okay. And one of the reasons why we feel that the market's going to continue to expand is that we had the big, beautiful bill passed last July, and there's a lot of tailwinds in terms of tax legislation, some stimulus that we're going to continue to see in 2026. That stimulus will kind of dissipate a bit in the upcoming years, but we still feel pretty strongly that 2026 will be a good, strong year. Okay. This is if you've never seen this chart before, this represents all the major asset classes that we can invest in. And you can see on the left-hand side that from 2011 to 2025, large caps have outperformed everything on average for that period of time. And the worst asset class during that period of time is commodities. And you can see that the colors will shift. It's a constant game of sector rotation. And you can see in 2025 that large cap, primarily again the S&P 500, was up roughly 18%, but really underperformed international and emerging markets. Now, which is really interesting. If you look at the purple line in 2025, that was the best performing asset class. But if you look at the previous year in 2024, it's sort of the middle of the pack, 2023 is sort of the lower middle of the pack. 22 and 21 was at the bottom quartile. So, this is a perfect example of sector rotation and making sure that you've got good managers who are diversifying and making sure that you are exposed to the asset classes that are doing well. And this is sort of, again, we're more on the tactical side where we feel that you should have a little overweight to the sectors that are doing well and a little underweight to the sectors that aren't doing so well. But that gives you an idea of what's going on. You can also see your white box, which is your asset allocation fund. That represents a 60-40 portfolio. That was up about just shy of 16%. And I'm going to talk about one reason why that was in just the next couple slides. So again, 2025, another really good year. And we do see more room to go. And I don't think we have reached the peak of the market, at least in the short term, by any stretch of the imagination. Okay, and this is just a visual representation of what's going on with the S&P 500. You can see the far left segment, that was 2021, had a really nice year. 2022, the Fed was raising interest rates, downward pressure on stocks, downward pressure on bonds. And 2023 was a comeback year that was really driven by the Mag 7, the Magnificent 7. I'm going to talk about that in the next couple slides. And then we kind of see that the market continued to broaden out in 2024, continue to broaden out in 2025, despite the tariff scare. Remember, we had a new administration coming in the office, a lot of tariffs thrown around. We had Liberation Day in April, and that caused a pullback of roughly 15+% in the market. But you see how quickly the market rebounded last year. Okay, again, another argument to stay fully invested in a diversified portfolio. Because if you got out, you don't know when to get back in, and all of a sudden the market took off, you would have been left behind. Okay, so I love this chart right here because it really kind of illustrates how important the Mag 7 has been. So if you see in the upper left quadrant of the screen, the green, the Mag 7. Well, in 2022, when everything was falling, remember, technology really got hurt. The Mag 7 was down negative 40%. In 2022, the rest of the S&P 500 was down negative 12. But when we saw the markets turn around in 2023, the Mag 7 just crushed it. They were up 76%, and the rest of the S&P 500 was up 11, and the S&P ended up as a whole at plus 24 in 2023. And those gains really kind of happened sort of towards the end of the fourth quarter, and things started to broaden out. In 2024, we saw the Mag 7 was up 48%. The rest of the S&P was up 14. Still had another very positive year in 2024, 2025. Again, the market was driven by the Mag 7, but you see it was only up 23%, and the rest of the market was kind of catching up a little bit. So on the lower left, you can kind of see the green rectangle. That was the Mag 7, and the blue was the rest of the S&P 500, the 493 stocks that are not in the Mag 7. And on your right screen, you can see the 7 stocks in the S&P 500, and you can see in 2023, like Nvidia and Meta were just crushing it. And you can see that Nvidia has still been doing well, but not nearly the kind of rates of return that it did in 2023 and 2024. Okay, so last year we actually saw that only 2 Mag 7 companies outperformed the S&P 500. One was Alphabet or Google, and the other one was Nvidia. And you can see the rest, the remaining 5, actually underperformed the S&P 500. So what we saw is that we're starting to see a widening out of the market, but it also shows a real opportunity for active stock pickers. A lot of the people that we see, and again, a bunch of our clients are very much passive index people. Oh, I'm going to just own the S&P 500. I'm going to keep money in my TSP, or I got these Vanguard ETFs over here. That's fine. A lot of wealth has been created with passive index investing, but sometimes there are opportunities for for active stock pickers, and this is certainly one of those times. And the active stock pickers who do a good job, and we've seen definite alpha and outperformance with really good proactive money managers. Okay, so this is also something too, is that, remember, the Mag 7 is going to be primarily large cap growth. That's that AI trade. And obviously large cap growth, it was just crushing it from 2023 to the present. But now we're starting to see again, a little sector rotation and things kind of becoming more balanced. And you can see in the lower right part of your screen, the value versus growth PEs, that the valuations on value are much lower. And we really see a lot more room for growth in the value space. And so that's one thing that we've been kind of seeing is more of a broadening out of the markets, where again, on the far right side, you've got the Mag 7, and then you've got the gray, which is the rest of the SP 500. But you also see in the dark amount on the far right, the small and mid caps. And you can see there's been a real comeback in the small mid cap space. So this is where you can't just be invested in the S&P 500. This is where having a true diversified portfolio in both domestic and international, and to have some exposure to small mid cap stocks has really paid off. Okay, interest rates always move in the markets. So you can see the interest rates get moved around all the time. If you look at the bottom of your screen, sort of 2/3 of the way across, you'll see 2020. That's during COVID. Again, the Fed lowered interest rates at that point, and then we started seeing an overheating of the market, lots of inflation. So in 2021 to 22, the market was, the Fed was significantly, very abruptly rising interest rates to cool down inflation. And so that put downward pressure on stocks, downward pressure on bonds. And since then, we've seen in 24 and 25 some rate cuts, which have been kind of used to kind of stimulate the economy. We know that Trump wants the Fed to lower interest rates. I'm not sure if that's going to happen, but again, there's a lot more room for the Fed to go either direction. But you can kind of see where things are kind of landing right now. So again, we're sort of a wait and see approach. I think we just saw a report today from the CBO that inflation dropped a little bit from 2.8 to 2.7. And so I'm not sure how compelling the Fed feels to actually lower interest rates anymore in the short term. We'll see what happens. Okay. Now, I love this chart because it kind of shows there's three different items to look at here. You have nominal yields, that's what you get in, say, a 10-year treasury. That's kind of close to what a CD is doing. But at the end of the year, a 10-year treasury was doing just over 4%. And then you take the light blue, which is inflation. So if you subtract inflation from the nominal yield, that leaves you with the real yield. So you can still make, net after inflation, roughly 1.5% on your money. That's nothing to jump up and down and get excited about. But yes, you can keep up with inflation a bit without taking any kind of market risk in that regard. So anyway, so again, I'm going to be talking about cash in just a little bit, but you can kind of see right there, there's a lot of money on the sidelines. And if you're sitting on a lot of cash, now might be a great time to start thinking about kind of move it to other vehicles. Okay. And again, this is just a great chart of $7.7 trillion of cash on the sidelines. And we see this with the clients that we see. And it's definitely now a time to really be very strategic about what you're going to do with that cash. Okay. And just to give you some idea, just going into global fixed income, we've seen U.S. bonds doing well, kind of in the low 7% range. But we've also seen opportunities in international fixed income, Italy, China, Europe. We're starting to see some double-digit returns in global fixed income. So this is one thing that, again, we see. Again, I got a lot of clients in the TSP. There's only 5 funds. You got the F fund and you've got the G fund. Well, the F fund is the U.S. aggregate. That was up roughly 7, and the G fund was up roughly 4-ish. Well, so, I mean, that's one of the, again, the arguments is that if you're sitting on a bunch of cash or you like your TSP and you have the opportunity to roll that over, a lot of times it makes sense because you just literally do not have exposure to the asset classes that you would ideally want to have exposure to that can make a better return in many cases. So we see some really nice opportunities in global fixed income. Okay. And kind of staying with that global theme, you can see on the left side of your screen, the black line is the S&P 500 minus NVIDIA, and the blue is Japan, and green is Europe. And so you can see that, those Europe and Japan have been doing very nicely and actually outperforming the S&P 500, again, ex NVIDIA, for the last few years. And if on the right side of your screen, you can see some real nice sector plays. European, aerospace, space and defense, Taiwanese technology, international banks, and so forth. So it's really, if you're overweighted in U.S., that's not such a bad idea, but you got to have some exposure to international. We're really seeing great opportunities right there. And that's certainly an opportunity to rebalance your portfolio to make sure you have enough exposure to international. Okay. So let's kind of talk about the currents that are constantly changing right now. We're going to kind of get in the weeds a little bit. So a year ago, we had a new administration come in, and you can see the lower part of the screen that we had 125 executive orders. Now, when you throw that number of executive orders at things, then there's going to be some uncertainty. There's going to be some volatility involved. And so what I'm going to cover right here are 4 major policies that are currently having the biggest impact on the U.S. economy and on us. Okay. So the first one being the regulatory rollbacks. And again, with the big, beautiful bill that was passed, again, there's very aggressive deregulation, rolling back a lot of federal regulations, projected to impose hundreds of billions of dollars of compliance costs. So I don't need to go into that. You've kind of seen what the government's done, getting rid of a USDA, the whole thing with Elon Musk and Doge. So there's been a huge effort to kind of pare down the government and roll back a lot of these regulations. Okay. Now, the economic effect of that is that it can actually relieve a lot of the compliance costs that businesses have that could also kind of stymie growth. But the other thing too is that, again, the long-term investment incentives may improve if the regulatory uncertainty decreases. Right now, there's still a lot of uncertainty with tariffs, which is the next thing I want to talk about. So if we can get some of this uncertainty kind of taken care of, then I think businesses will be a little more willing to make long-term investments. Okay. Now, there's a flip side to the coin. Now, when you start rolling back your regulations, that could have consequences when it comes to the environment, to the FDA and the health. And again, these could have indirect economic impacts through public health costs and climate risk. Okay, so there's always 2 sides of the coin, right? So we're not going to get into politics on this, but this is kind of where we're going right here with the regulatory, deregulation. Okay. Now, the other thing is that we've got trade and tariff-related executive actions. So, and that was one reason why the markets kind of sold off about a year ago, was that Trump was using tariffs as a negotiating tool, and he was putting them on our allies, China, Mexico, Canada. Actually, China's not our ally, but Mexico and Canada certainly are. And so, that really moved markets around, and there's sort of that taco trade. You do a tariff, then you kind of back it off. So that caused a lot of kind of uncertainty. And when you have a tariff, ultimately the person who imports that good or service or that good into the country ultimately has to pay the tariff to the U.S. Treasury. So those tariffs get kind of passed on to the consumer. And we really saw that in areas like the lumber and building materials and manufacturing. And we've also saw sort of a retaliatory, kind of reaction where other countries say, well, hey, we're just going to raise tariffs on you. And that could actually hurt our exports. So there's a whole lot of stuff that's kind of being worked out here with the tariffs and the different alliances that are happening with different trading partners throughout the world right now. And so, again, when you have this environment, there's a lot of business uncertainty and investment caution, as I said in the last slide or so. Again, if there's some certainty, I think companies will be in a little better position to make more long-term investments in their business. Okay. The third one is immigration and labor market policies. I'm going to go a little depth into this because I think this is important. So again, we've got the tightening of the immigration enforcement and reducing of unauthorized immigration. So when you are going after illegal immigrants, that a lot of the illegal immigrants, where they earn their money is in kind of labor, where you're out in the farms, or picking soybeans or wine in Napa, or wherever. So we've seen labor shortages in agriculture and construction and in hospitality. And the economic effect on that is that, again, there's reduced labor supply. And again, that could lead to higher labor costs, which slower project completion and potential output reductions. And again, it's just hard for companies to find workers that are, there are fewer people there to hire to actually get the work done. So what that's doing is that it's actually putting upward pressure on prices because the labor costs have gone up. So what that's done is that we actually have a direct loss in tax contributions from immigrant households. So whether you are here as an immigrant legally or illegally, you're still going to the grocery store, you're paying sales tax, if you own a home, you're paying property tax, you're paying income tax, and there's excise taxes. So whether you're legal or illegal, you're still contributing to the tax foundation of our economy. Okay. In fact, in 2022, undocumented immigrants paid an estimated $37.3 billion in state and local taxes nationwide, including roughly $15.1 billion in sales and excise tax, $10.4 billion in property taxes, $7 billion in personal and business income taxes. That's a lot of money of what undocumented immigrants have kind of paid into our system. Okay. And if you look at that, that's about $8,889 per undocumented person in combined tax payments. Okay. So it kind of makes sense that if this immigrant population starts to go away from deportations or whatever, then obviously the tax revenue that we were receiving is also going to be reduced as well. So that's certainly a residual effect of that. So we're also seeing reduced consumer spending and sales tax revenue. That makes sense. I just kind of talked about that. And also, if you have people who are feared of being, arrested by ICE, they're not going to go outside as much. They're not going to be buying goods and services and paying that sales tax. Okay, so that can be an issue. You also have the labor market effects of property tax-based erosion. So again, immigrants buy houses as well as everybody else. And again, that helps sustain higher property tax revenues. And it really kind of shows that the presence has helped to increase and sustain property values. So indirectly generating additional property tax revenue beyond, what they pay directly. So when you have this enforcement, the government, taking immigrants out of the country, that leads to a potential property value decline or a stall in property values, which could reduce the property taxes. And that's less money that kind of goes into our state and local taxes, because that's where a lot of our local revenue comes from, is from property taxes. Okay. A fourth one is the lower tax compliance if immigrants avoid filing. So it's just very simple. It's like if you're not filing your tax returns, the government's not getting money. So, again, if experts have warned that policies linking tax data with immigration enforcement could discourage tax filing by the immigrants, and which could potentially reduce the tax revenue going in from just income tax filing for state and federal tax returns. Okay, so that is a big issue that's again, state and local taxes are, again, municipalities are not receiving revenue that they had before this, kind of ICE roundup. All right. The loss of tax revenue, again, talk about the labor shortages. And again, the labor shortages really affect the agriculture, the construction, the hospitality. And remember, they're out there. earning money. There's employment taxes that they're paying. So when you're unemployed, that federal and state and those FICA taxes are not being paid, and therefore that's just less revenue going into the system. Okay, that could also lead to slower business activity and also just lower earnings for remaining workers, which cuts income tax receipts and dampens spending on taxable goods. And again, the economic disruptions of ICE. I mean, just people just don't want to go outside. They don't want to. They're not going to work, and so it just has these broad ripple effects on the economy. Okay, so when you kind of look at sort of the the different channels right here. So you look at direct contributions from immigrant workers and households. So if they're working, they're paying in the system. The effect on revenue, if they're not there, is that there's decline with reduced population and participation. Again, with immigration, with immigrants, into society, their consumer spending and sales tax is going to decrease if again there are not as many people buying goods and services. Potential decline if demand for occupancy falls in their property taxes. The tax compliance behavior, if people just don't file their taxes, that's money that's not going to come into the IRS. And also just reduced activity lowers income and business tax receipts. Okay. So again, I think people have been really focusing on the tactics of ICE in Minnesota and different places. But what I'm trying to kind of bring to the table is like, yeah, that's horrible, but there's also an economic effect or sort of ripple effect that's happening as a result of these policies. I'm not saying it's right or wrong. I'm just saying that there is, definitely a loss of tax revenue and an increase of inflation with this current administration and the policies there. Okay. So, and finally, we also have market and business confidence. Again, when you throw in some, tariffs and, it just adds a lot of uncertainty, and businesses are just a little shy about making, these $100 million commitments to building factories and doing stuff. So they just kind of pump the brakes a little bit and see what happens in the next administration. Okay. So kind of switching gears a little bit. So those are the four main areas within that the policies are affecting. And to kind of piggyback on that, we've always had really bad deficits. It's just gotten worse and worse and worse. So fiscal year 2024, the federal debt was over 35.5 trillion. Just as of 5 weeks ago, it was over 38.6 trillion. So just in a short period of time, we've just seen the deficits continue to just balloon. And, one thing you can see, you can break down what's coming into the economy. Again, the economy is actually doing fairly well, and there's still unemployment is still pretty low, so there's still pretty good jobs, and so we've actually seen about a $36 billion increase in individual income and payroll taxes, which is not great for us, but it's great for the government getting tax revenue. But we've also seen about 22 billion or a 318% increase in customs duties due to the increased tariffs. So those tariffs are going directly into our treasury, which is helping to reduce the federal deficit a little bit. But those little tariffs are a drop in the bucket compared to the tax cuts that have gone to these major corporations. And so you've kind of seen that corporate America has had these huge tax cuts that's kind of helped them out, and that's also actually hurt the deficits. So again, that's just part of the big beautiful bill, and this is what the administration passed. Okay, so the other thing is when we look at the debt projections, continue to be revised upward. So if you look at the bottom, that was the CBO 2025 baseline. And they just keep on kind of resetting it so it goes higher and higher, higher. The blue line was, they adjusted it in August. The red was they adjusted it in November. And you can see the top one with the dotted line. So if the Supreme Court rules that the tariffs are illegal, then the debt projections just continue to go up even more. So I think that's in the Supreme Court right now. So we'll see where that lands. But anyway, regardless, I mean, the debt projections are definitely growing exponentially. The tariff revenue that's coming in is not curbing the amount of the overall growth in the deficits, and that's a really important point. One thing I was going to kind of mention, and I could, if you send me an email, I'll send this to you. But if you go to cbo.gov, the CBO actually has a new report that came out that talked about the breakdown. It's roughly about a $1.9 trillion deficit. We had some money coming in from tariffs, and then we also had there's one other thing that they're talking about. But the point is that there's a 172-page report that kind of breaks down what the CBO is trying to calculate. The main thing is that what I'm trying to get, the point I'm trying to make with all this background is that there's a lot of uncertainty. You need a diversified portfolio. We feel very strongly that you need proactive money managers. It's basically, we're kind of in a stock pickers kind of environment right now. So having really good managers, having a diversified portfolio, having exposure, equal balance between growth and value, and also some small mid cap, and especially international, is definitely a way to go. But, again, as a sort of a recap, again, we remain bullish. Both stocks and bonds should continue to do pretty well. Again, we're overweight equities. We should feel that you should stay fully invested, not raise a bunch of cash right now. Again, the portfolio allocation, again, should be a little bit more neutral with exposure to value, small mid caps, international equities, and fixed income. And again, we feel like you should take some cash off the table. There's so many opportunities to get a little higher yield than just in a money market right now or a CD. And again, so I think for the remainder of this administration, the policies are going to be very kind of isolationist. So that leads to other opportunities, especially you just have to find them. We really see those opportunities in the international space in both equities and fixed income. And again, this is just a very complex landscape. And this is where, professional managers are in a much better position to make those tactical moves in your portfolio to achieve competitive returns, lower risk, and minimize taxes. And if you attended we have a new investment class. That's one of the things that we talk about, is that in order to produce a perfect meal, a fantastic meal, you need three components. You need really good ingredients. You need a good recipe, but you also have to have the skill to actually cook and put that dish and deliver it. In investment terms, you got to have good ingredients, which are the good investments that you own, but you need a good allocation. That's your recipe. But where people fall apart is that they may not have a good recipe, but they definitely don't have the training, the time, the dedication, the financial tools to be able to kind of navigate these really volatile times and to make sure that the portfolio is optimal. Okay, so that's a really critical part about kind of navigating these waters. Okay, so that's the main thing, is that you got to have really good money management. The second thing is that hopefully you got from my commentary that taxes are most likely going to go up for many different reasons. So in your qualified accounts, your pre-tax accounts, Roth conversions can make a lot of sense. If you are retired or close to retiring, doing conversions now before the next administration, I would be advisable. Just because, again, we can lock in those current tax rates right now. One of the reasons why people don't do that is that if they do conversions, it may ultimately increase the Medicare premiums by increasing the IRMA limits. But we have software that we can calculate that for you to find the right amount to convert and stay in a certain tax bracket. For money that's not in IRAs or 401ks, your what we call non-qualified or taxable accounts, there's so many opportunities to do tax loss harvesting and minimize those capital gains. For accounts over $50,000, we use very, very efficient, tax efficient, low cost ETF models that do proactive tax loss harvesting. We use a third party company called 55IP to do tax loss harvesting on already very tax efficient portfolios that are super low cost. If you have over, $100,000 to $250,000 minimum, that's where you should really consider looking into direct indexing. If you're not familiar with that concept, we can certainly kind of talk about it. But instead of owning the S&P 500 and one ETF or mutual fund, you're actually owning the 500 stocks or maybe half those stocks in your brokerage account. And you just have, so you're actually owning the individual positions versus one mutual fund or ETF that owns the S&P 500. So we've seen direct indexing is really saving clients crazy amounts of money. And just to give you an idea, this is a client that we had an active stock portfolio in 2024. There was over $67,000 of net gains in that portfolio. And that ultimately cost them over $10,000 on their tax return just from that one account. Well, where does that money come from? It comes from your lifestyle. No one sells their funds or ETFs or mutual funds or stocks to pay the taxes. It typically comes from someplace else. So what we were able to do is we were able to take that account that was costing the client tons of money in capital gains tax, and we actually moved it to a direct indexing, separately managed account with one of our managers that we use. And you can see last year, we dropped down the gains from $67,774 in 2024 to just over $7,100 in 2025. Let's just say it was all long-term capital gains. The prior year it cost the client over $10,000 in taxes. Last year, it cost the client $1,065. That's a huge reduction in capital gains tax. And the performance was still phenomenal, right? So this was an example of, the direct index and some of the tools that we have. And again, what we're ultimately trying to do is we're trying to improve the net after-tax performance and save, again, the client over $9,100 in capital gains tax from the previous year. Okay. Remember, your rate of return is not the rate of return on your statement. It's the rate of return on your statement minus the taxes that you pay. So if we can reduce the taxes that you pay, we've effectively increased your net after-tax return. Okay. All right. So anyway, that concludes my presentation. And again, if you're a client of mine, you can certainly schedule a financial review and a meeting. And, if you're kind of considering kind of working with us, then you can certainly schedule a time and we'd be happy to kind of talk to you about things and our services, what we can do for you. But again, I'm going to leave you on a positive note of the Caribbean. Yes, that's my left foot right there. I actually do get a chance to relax every once in a while. And so I hope you guys enjoyed the state of the market and the market update. And I hope you stay warm and hopefully you get to the beach sometime this year. Listen, this is Jim Musgrave. Thank you so much for watching, and we'll talk to you later.